the CEO of First Mining Gold. First Mining is advancing 2 of the 10 largest undeveloped gold projects in Canada, our Springpole project in Ontario and our Duparquet project in Quebec.
And Hayden, Locke, President and CEO of Marimaca Copper. We're developing the Marimaca Oxide project in northern Chile. We've just closed a significant new investment, and that's going to allow us to really start pushing ahead very aggressively on our development plans.
Guys, so thanks for joining us. Right, we got gold, we got copper, getting 2 of the commodities and metals in the news at the moment, prices rising, all good stuff. But you guys still got a lot of work to do. Dan, with you, advanced development, how far along the stage are you?
So yeah, at Springpole, we're one of the most advanced projects in the environmental assessment process in Canada. So we are finalizing our final EA, which we're aiming to submit in October of this year.
Right.
So that environmental assessment is, we've been in that process for 6.5 years, really kind of coming toward that major permitting milestone of environmental assessment, targeting having that approval by the end of 2025.
Right, okay. And Hayden, same for you. You've just had a big strategic investor come in. Where are you at?
Yeah, similar to Dan, we are in the final throes of preparing our application. We'll be submitting our environmental application, which is kind of like an EA in the Canadian sense. Ours is called a DIA in Spanish. That'll be out in the next sort of 6 to 8 weeks, and we're expecting a 12-month permitting timeline to get our environmental approvals.
Right, okay. So the reason I asked you guys to join me here is because I want people to understand the sort of the development phase of their investment. It's also off the back of, I was meant to be interviewing someone, a company today, and I was kind of doing the research as usual on them, and they, in the press release, noticed that 3 people this year have died. 3 separate incidents. 3 people have died at their property. And it seems to be the average for the last 5 years for them, right? So I will not interview that. I will not entertain promoting or having a company like that on our platform. It made me think there's a lot that you guys need to take care of to kind of get over the line, and it's all really, really important. The social component for both countries, really, really, really important. I mean, Dan, for you, the EIA is part of the mix, but the kind of social component and what you're promising there is equally important. Again, so update on that, please.
Yeah, so I mean, for us, obviously, in Canada, working with Indigenous communities is a huge part of that environmental assessment and ultimately your social license of a project. We're working with 5 Indigenous communities around Springpole, really 1 Indigenous community around our Duparquet project in Quebec, but we'll kind of focus on Springpole for now. I think it's a huge part of the understanding of the social value and the value that mining projects can bring, in a lot of cases to remote communities, which are the communities that we're working with. How can these projects drive not just economic growth, not just development of human capital, but drive infrastructure up to these communities? And in certainly in the case of one of the communities we're working with, it's remote communities serviced only by winter roads. Those winter roads are a lot less reliable than they have been over many of the, the past years. So a real focus of driving an all-season road up to that community to allow people to benefit from, direct employment opportunities to drive down and come to work in a mine, number 1. But number 2, connect that remote community to other services and infrastructure that can, I think, really change the lives of the people in those communities. And in often cases, give that sense of connectedness and a little more of a sense of hope on the day-to-day.
Right. And what's it like down in Chile for you, Hayden? Because, Chile is a copper country. It's a mining country. It's all well understood. Ease of business down there?
Well, it depends on where you are in Chile. And similar to what you experience in Canada and indeed Australia, there are Indigenous populations that need to be managed in terms of your social license to operate. But I think from our perspective, and I'm sure this is the same for Dan, even in the context of Marimaca where we don't have an Indigenous population, the mining industry, as a general rule, looks at it that these projects must be developed to the benefit of all stakeholders, not just our shareholders, not just our debt providers, but all stakeholders. And one of the key stakeholders that you allude to there, Matt, is our employees. I mean, I could think of nothing worse than having to go and deliver the news to a family about somebody dying on a mine site or involved in one of our operations. So I think we think about it in a holistic sense that all stakeholders need to benefit from the development of this project. Our capital providers need to get a return. The local communities need to get an investment and some sort of return. And so that's a big focus for us, even without the Indigenous angle.
Right. Now, we had one, I think you both know him, Alex Black from Rio too. He was on the show doing a panel session like this a couple of weeks ago. He took over. It was fantastic. I loved it. Lazy interviewer, enthusiastic interviewee. I would ask both of you maybe to sort of challenge each other or ask each other questions whilst we go into this. I think the what you guys know is what people are here to learn. So do feel free to sort of interrupt each other or ask each other questions as we go along. I'll kind of interject where I can. I mean, Dan, for you in the stage that you're at, in the market that you're at, you're looking at almost 2,500 gold at the moment. Is that a kind of cure-all for you? Does it solve a lot of problems, or do the fundamental things still need to happen in the right order?
Well, I mean, I think you need to understand what you mean by fundamentals, right? The fundamentals in a project like this, in spite of the gold price isn't kind of a fundamental for us. That hasn't changed anything. The fundamentals are you need to, have a robust, well thought through project where you've done all of the homework that you need to do on, environmental impact. You have to have kind of gone through a process. You need to be advancing those relationships with the communities that you're working with. Like, those to me are the fundamental things. The gold price is kind of a bit of a determinant of the overall level of profitability. And yeah, for us, when that gold price starts impacting access to capital, which it hasn't yet for the gold developers, then it'll be a really positive thing. But for us right now, the world doesn't seem to believe a high $2,400 gold price. So when it translates into flows of capital into the sector, then yeah, I think it's going to have more of an impact. Until then, we just keep pointing at the fact that our projects have unbelievable leverage to the gold price. I'm talking like $250 million US after tax net present value increase for every $100 in the gold price. So we got lots of fundamental value, right? We've got more than $4 of fundamental value a share, and we're trading at 14 cents.
But when you say things like that to me, Dan, I kind of get a little bit excited because it says there's a bunch of stuff which is way out of your control, like gold price, which can drive the value of your company to a potential acquisitor, or certainly, I imagine, or someone with a bigger balance sheet, a major, which needs to backfill their reserve numbers or resource numbers. And there's a model. You could be suggested from what you just said, which say, well, look, let's forget about the de-risking here, because those ounces in the ground are getting more and more valuable because the market's doing its thing. Let's stop spending money, not worry about it, right?
Yes, but I'm a big believer that luck favors the prepared, right? So you can be lucky and hope to time a market. That's not really a strategy. We've always said since 2019, when I started as CEO here, like, we want to have these projects ready for when the industry needs them the most. And turns out our timing's going to be pretty good. Like, if you'd have asked us in 2019, when the gold price was $1,300, what our share price would be with, one 5 million ounce project, because we didn't own Duparquet at that time, what our share price would be when the gold price was $2,500, I'd have been, easily 10x from where we are now. It's just, it hasn't translated into investment interest and investment flows into the development sector, but it has to come. It has to come. So yeah, no, it's a very exciting time as we're looking at it right here. It's the investors' opportunity to front run what is going to be like a super cycle size trade.
Right, and you've been the same thing. Copper's been the same, but it went up to $5. A couple of months ago, back down at sort of about 440-ish. At the moment,
terrible.
Yeah, terrible. 440. How
horrible.
Yeah, exactly. What a disaster.
Well, was it 380? Was it about 350 to 380 most of last year? Yes, it's good, but at the same time, you can't help that psychology of getting a little bit excited when it hits $5, and you think, well, what's that going to do for my project? What does that do for your project if you keep going?
Well, I mean, it looks ridiculous, but the way we are approaching the development of our project is what happens in the downside. And does this make money in the downside? And if we borrow money, will we be able to pay back our debt? And, we let the speculation occur on the other side, which is not our job to speculate what happens if the copper price goes up. I think Dan was alluding to it. It's not our job to speculate on where the price is going to go. That's, investors are investing because they believe there's a cycle coming. Our job is to de-risk the project and prepare it as best we can to understand the full value. So if somebody does want to buy it, they pay the right price for it. And the only way to get that right price is if you're prepared and you understand how you're going to develop the project. And if the right price isn't forthcoming, then you have to be prepared to build it. And, that's what I'm most excited about. I don't really want to sell. I want to build.
But do you think copper's a better bet than gold at the moment?
No, I think I'm really bullish on both, to be fair.
Okay.
I'm probably slightly bullish in a different way on copper, given that I think it's a long-term demand trend, 5 to 10 year demand trend. Whereas gold I'm more bullish on because I have just seen years and years and years of money being printed, and I've yet to see the full effects of that, I think, come through in terms of inflation. And I feel like that's a big reason why people are buying gold at the moment, is there's still that underlying fear that the money supply has been blown up by the Fed over the last decade.
Yeah, and if you think that's been big, just wait till you get another Trump presidency, right? Like, they're even talking today about, Trump signaling and Vance signaling that they need a weaker U.S. dollar. Well, gold's in its very early stages of a run. And it was 1,300. We used to talk about, let's think back to the previous cycle. It went from about 260 to 1,900, which was about 6x, trough to peak. So let's say that this was 1,100 at the trough in this cycle. So, 5,000 or 6,000 is pretty straightforward. But I do really like the copper fundamentals. I remember in my previous life as a fund manager, we looked for 5 years to try and find copper projects that you could invest in that, would give you good exposure and long-term exposure to copper at a $3 level. And it was actually really hard to find copper projects globally that worked at $3. So it just says to me,
it's probably hard now at 350.
Yeah, or 4, right? Like I think you're set up, and again, I agree, it's a very different kind of fundamental reason, but both I think are super bullish. I think copper is there's going to come a point where there's just not enough of it around for industry to do what it wants to do. And I think you're going to wake up one day and see, in a very short period of time, kind of like we saw in nickel without a supply response, because there's no like laterite copper that just gets turned on, right? Like it's a long-term structural challenge in that copper industry, and they just cannot add the capacity as quickly as they're going to need to. So I think it's got very interesting supply demand fundamentals.
So how do you build companies? And so we're going through this development phase, each of you, right? And you're designing a company which is going to be attractive to someone to come in with a big balance sheet and buy this thing. And it's not just a simple case of we're trying to they're trying to increase their reserves and resource reserves here. It's got to be built a way which is going to be more attractive than the next guy, right? And Dan, you've referenced, you've got 2 of the top 10 largest projects in Canada, but that still leaves a few other people at the table. So in terms of that construction of your company, is it being constructed by you to generate cash? Is it being constructed by you to look like a kind of blue sky exploration potential upside, beyond the 2 assets? I mean, what are you building and who for?
It's a good question. I mean, I think for us, we kind of see our role and have always seen our role as, we're not set up as a company right now to be someone who builds $1 billion project. Now, we need either a different market environment. You can certainly build a team to do that. Our focus and in some sense is dictated by challenging access to capital markets over the last few years, has been have a small focus team concentrated on tackling the biggest risks and managing and mitigating the biggest risks, or understanding the biggest risks of a project. And that for Springpole certainly has been the case. because it is a large project that needs to be developed in a significant way. So in that respect, for that project, you're kind of scoping it to be attractive, likely to a partner is the way that we think about it, not necessarily someone coming in to cut you a huge check, but there is going to be someone, a project's big enough that a 50% interest or 60% interest in that project is still meaningful production. So it's tackling things in the right way. It's doing work at a certain quality that is going to give confidence that all the work that you have done is something that, truly and accurately reflects the risks and the process in the business. With our Duparquet project, it's a bit different because, there's a scenario at Duparquet, which I think the ore body gives you the flexibility to potentially start smaller and expand. And so that's something that we're looking at now. And that start smaller could be the fact that we are sitting in the middle of the Abitibi Gold Belt and we've got 17 mills within 200 kilometers of this project. So there is a real flexibility there if you have a bit of a higher grade starter operation to understand your ability to either purchase one of those mills or partner with someone who has one to be able to get to cash flow with much lower capital. But that's all driven by the capital environment right now. If we were in the capital environment we were in 2010 or 2011, I can tell you right now, this would be a $1 billion market cap company. You could raise $100 million a year without really diluting your shareholders too much and get a lot of that fundamental work done. The market's not valuing these development opportunities, or put another way, they're putting a really high discount rate on development risk. And some of that development risk is perceived access to capital risk, sort of capital overhang, but some of it's, it's inflation, which has been a big concern, cost inflation, capital and operating cost inflation in the industry. The reality is I think we're past the worst of that now. So people who are looking at projects, which are by definition long CapEx, I think are now getting to a point where they can have certainty in a current engineering estimate of what things are going to cost, and more appetite to take on that development risk.
I think the difference in gold and copper is interesting to me. We did a study recently on some majors, and also something which will probably be going out over the weekend on, I guess, sub 400,000 ounce producers. In terms of their ability to generate cash net of investments. And the big guys, the majors, sitting around 12%, but the kind of, I guess, the sub 400,000 ounce group, sitting around 5%, slightly over 5%. So there are efficiencies from scale given there, and I guess, de-risked in terms of jurisdiction and all those wonderful things. So from that point of view, I can sort of see how gold is big is better. Copper, Hayden, that's a bit harder. You don't see too many super big global copper companies. Again, so in terms of how you construct your company for sale and to kind of get the biggest kind of payout, how do you go about doing that?
Well, I have to say, I agree completely with what Dan was saying in that, that should be music to investors' ears, that he's not pushing to develop for develop's sake when you're trading at an intrinsic discount to the value of the project. You've got to be patient sometimes, as we all know. I mean, you've had several people on your show who are big players in the mining industry who have said this is a long-term game. You've got to think long-term, and if you don't think long-term, you will inevitably sell too cheaply or push ahead and dilute yourself too much when you shouldn't be. And so you have to be patient. So it's the reason it's slightly different is copper is hot at the moment and there is money available and everyone wants to be involved. And so now is the right time to be financing a copper project. I worked in gold in 2010, 2011, and it was the right time to be financing a gold project. So, I think it's absolutely right. In terms of, there are very few small copper projects, I think is what I would say. There are almost no copper projects other than ours, really, that are below $1 billion of CapEx, and the vast majority are multi-billion dollars of CapEx. And in that case, you definitely need a major partner. There are almost no financial partners or, mid-tier strategic partners who are willing to risk their balance sheet for a project of that scale. And so you need a BHP, Rio, Glencore, Anglo American, or one of those big players to partner with you. And what we're hearing from all of those groups, Gary Nagle has said it, we will not greenlight El Pachon and Mara until we see $15,000 a ton copper, which is over $7 a pound. So, the CEOs are telling us there's not going to be a supply response until we see a much higher copper price. It's just a difference in the cycles is my view.
Right. Dan, are you invested in copper?
I don't really own any copper exposure right now in the book. It's mostly first mining gold, as it turns out. So, it's not exactly true. I do have a significant investment in a polymetallic deposit in Canada that's being advanced, Magna Mining, which is a
They're
very
good
interesting.
guys.
Yeah,
good
very
guys.
good guys. Yeah.
Yeah, I like that. So, if you were to think about wanting to get into copper, what do you see a lot of parallels to what you've got to go through, or do you think the kind of market dynamics are somewhat different, and you need to understand those before you could cast us investing into Marimaca, say?
No, I listen. I think the difference is Hayden's done a very good job of articulating kind of the strategic dynamic around copper, and ultimately, who are the people that can develop bigger copper projects. He's in a bit of a unique position because, I spent 5 years looking for smallish copper projects that were economic, and they're very, very rare and hard to find. The flip side of that is that you don't have this large, well-established set of mid-tiers like you do in the gold industry that are all people who may have 2 or 3 mines that at any point in time are going to be 3 or 4 years away from needing to be closed and needing to be replaced. You tend to have multi-generational assets that are developed for billions of capital, and your ultimate acquirers then are, the large cap guys, which is great because they can afford to pay a lot more. And the kind of mid-tier copper producers, there's just not that many of them. So it's just a different kind of strategic dynamic that way. But again, I think for copper, something that can get to cash flow or is an important part of someone's supply chain, whether that's going, to a certain smelter that needs the concentrate, for example. If it's an oxide copper project, you kind of get around that. But being an important part of someone's supply chain opens up a different strategic element in copper where that can be more important. Whereas in gold, kind of produce an ounce of gold, it's an ounce of gold, whether it's coming from here or there. So,
okay. And I've got one for you. Yeah.
Are you trying to play matchmaker?
Good. No.
I mean, Dan, where do we sign?
Absolutely.
I did one last week, and the guy did end up investing in the other guy's company. It was good. But no, here's one for you, right? We've seen in the last 3 years where since we've been talking, lots of conversations about we've got this catalyst, that catalyst. Everyone's talking about their catalyst moments, and those moments kind of came and went. And they were sort of desperate, reaching out, of trying to create a headline which probably didn't exist. So, what are the things when you look back in your development phase, you said, oh my goodness, I am glad to get that one out of the way because that was super, super important, the most important thing. And then while you're at it, what is the one thing that you genuinely think, if I get this thing nailed, we are done and hosed?
Yeah, I don't think there's any one thing in the development phase. It's all equally important. But right now, my key focus is on the permits. The biggest risk, as I see it, before you start construction is, can you get the thing permitted? Dan's a long way through his permitting process. We're about to start a final permitting process. And so that's a big focus for me. I won't say it's a concern yet, but, maybe a concern soon. Once we get into the development phase, my biggest concern is very much around the team that we're going to build out for the execution purposes. So we've got a fairly good handle, I think, on all the technical aspects. There's a few little things to iron out here and there. We benefit from having a relatively low complexity project, but building out a really strong execution team that can manage the various contractors that we build on will be my big worry for the next 12 to 18 months.
Right. And Dan, same for you, because I always wonder, was the acquisition of the second asset, was that a big moment that people should have paid attention to, or is there something else?
No, I like to think that it should be. I think what's interesting, the projects that we've acquired or the ones that we're choosing to spend our money really advancing, are kind of past the stage where most of those really big fundamental risks are understood, right? And that has everything to do with the fact that, when you look at the two main projects we have, there's probably been $350 million spent on advancing those projects over the last 10 years, maybe more. So all the big risks have kind of been checked. Like, are there things you need to understand about metallurgy? Sure. But all the work's been done. You have objective data that can tell you that, we're probably not going to get 98% recoveries, but, we can get 87, 88, and we're comfortable that that's done. So I agree with Hayden. It's a whole series of little things that happen, but the real oh shit moments for these projects tend to happen when it's like you're drilling it out. Do you have enough resource to be economic? Is it, do you have grades that are going to work? All of those things for us had been done years and years ago. So it is these incremental de-riskings toward shortening that time frame to a construction decision that are the big wins in the development space, because that's the same whether you're in Chile, whether you're in the US or Canada, whether you're in Australia. Australia's a pretty good place to permit projects, I would say, relatively on a timing basis.
Some parts.
Yeah, some parts. But the value of being at the end of that permitting process
is significant.
Is immense.
Yeah.
And I think we're going to see that, in the gold space in Canada. Again, we watch all of our peers pretty closely. Everyone talks about permitting a different way, but until the document is in the hands of the regulators and they are doing their work and, what the responses are, you don't really have a good way to handicap getting to the finish line. And that's why we're so excited. We've had a draft EA in the hands of regulators for more than 2 years. We've got 1,900 comments and questions back. We've answered all of those, right? Like, those are the steps where it's like, and so no one's trying to kill the project yet, right? Like, you get that kind of level of comfort that comes out of it. So,
and where do you think you sit on the very annoying Lassonde curve? Because I'm now looking at it and thinking, God, it's the best buying opportunity in mining if you do the work and understand whether the project is if you can do the work and understand whether the project is technically viable and that they can raise the money, then everyone should be loading up in this phase, shouldn't they?
Yeah, I mean, I think the Lassonde curve has become, to Pierre's own words, like the valley of death, right? That the killing fields, like that long part, it's now, exploration success, catastrophe on your share price as you start going through development. And then, it stretches out over 7 or 8 years. And then maybe when you're building a mine, it goes back up. This is the time. Maximum understanding of risk, shortest time to confirmation of your ability to build a project and demonstration of your social license. So, again, for us,
and then really the risk that investors have to contend with, and Matt, be interested for your perspective, is really how much dilution am I going to wear if I buy these shares today? But they have to trust management. We're not going to do a stupid deal that dilutes us when it's, as you said, it's a huge part of your net worth in the business. It's a huge part of my net worth in the business. I definitely don't want to be diluted as much as every other shareholder.
Oh man, we only invest in this phase now.
Yeah.
Right. That's it, because it's like, as Dan said, it's significantly de-risk, and obviously you still got to do your research and work out and make sure these guys aren't like, playing a game. But ultimately, this is the place where we make our biggest returns. We have done for the last 4 years, right in that kind of valley of death, to use your phrase again, Dan. Actually, you made an interesting point, Dan, about looking at your peers and stuff, getting a sense of what is going on there. We do something called an analyst note. We write up some notes and on various companies to see what we can learn. Okay, we're kind of pointing at stuff we think, well, that's not quite right. What's behind that? And we put these analyst notes out and we send it to CEOs. We send it. Hopefully, you're on the list. We get 94% of CEOs open that email and read it. We know they read it because we can measure how long they access the folder for. Only 30% of IR people read it. Shocking. So but I thought it was an interesting fact. But the CEOs, you're constantly looking at what other people are doing, see if there's anything to learn. How do you change stuff? How do I stop
100%.
making mistakes, right? And that kind of going back to the beginning of the conversation where I said, this company seems to be very comfortable with average, 3 people a year dying on their property. So this analysis and constant checking of what the peers are doing, what's going on, that's a big part of your working day, Hayden.
What went wrong? Yeah, absolutely.
Yeah.
And there have been some high-profile, I won't say disasters, but some high-profile companies that have had, let's say, challenges in their development. And as it was announced, the first thing I did was start to call people that were involved in the project and in the potential workout to ask them, what can I learn from this situation? I'm never happy to see it. As my old boss, Mark Connolly, used to say, we need more successes in this industry, not more failures. I never like to see it happen. But if there's a learning to be taken from it, I want to know. And, what I found in all of the conversations I've had is it comes down to things that are not easily estimable. So geotechnical as it leads to civil and earthworks, that can be a huge variance in number if you don't have that properly defined. And then the second is man hours and labor productivity. That can be a huge differential if you get that wrong, and it can completely change the scope of your project. And then the last bit is, if you underestimate the scale of what you need in terms of structural concrete and all of that sort of stuff, those things add up quite quickly to the costs. So it's those are the sort of 3 things that I'm focused on. Getting equipment prices and all of that's really easy. Anyone can do that. And the inflation, I said it on the last interview I had with you, inflation is there. Yes, we know it is, and we can plan for that. What we can't plan for is all those little bits that, if you don't do the work, you don't understand it before you actually start digging up the ground.
Yeah. And the trick is you have to do the work, right? Like, that's what it really comes down to, is more investment upfront in understanding some of those key things that went wrong. And we have the benefit, of hindsight with a bunch of projects in Canada over the last 4 years. You've had an unprecedented level of big project build in all kinds of different places across the country, like 7 major projects being built, and some of them, being built during a pandemic. And you get to see a lot of those things of what went wrong. But no, we spend a lot of time in sort of going through our feasibility study and really kind of lining up what is the next work that needs to happen, trying to understand what happened at some of the ones that had, $500 million to $1 billion cost overruns.
Yeah.
And inevitably, it's 2 things. We had the wrong contractor who just did a poor job, and we didn't do enough homework up front to really understand what we were dealing with under the surface.
Yeah, I mean, there's a great example of that. Dave Reeve down at Calidus, an Aussie gold player, wrong contractor, and he got absolutely, they've gone into administration. Good project, killed by the quality of the people they hired. There we go. Guys, I'm just conscious of time. I know, Hayden, you've got a Barbie that you've got to get ready for.
The shrimps are now burnt.
The shrimps, you are Australian. The shrimps need to go on the Barbie. Why don't you just take us out, each of you, maybe 2 minutes, reasons to buy your respective stocks. Go for it, Hayden.
Well, Marimaca is a very unique development stage copper asset. As I alluded to, copper is in an amazing setup for the next 5 to 10 years, and we're one of the few copper projects that can be financed and executed by us without a strategic partner. We've just got a new investment in, which allows us to accelerate, and we're going to be pushing aggressively on that while trying to avoid the valley of death by still doing some exploration.
And First Mining Gold, again, two of the 10 largest gold development projects in Canada. Major catalyst coming over the next 18 months that by any reasonable estimate should account for significant value re-rating as we finalize and ultimately receive our environmental assessment approvals at Springpole. And move forward du Parquet with what we think is going to look like a bit of a staged development process. More on that to come. And ultimately, same thing, amazing exploration opportunity. So really leverage to gold from your entry price, leverage to gold from the assets themselves, $250 million US NPV for every $100 in the gold price. And when your starting point is less than 100 million US market cap, that's the kind of leverage you want to have in a market like this. So leverage to fundamental value, leverage to re-rating, and leverage to exploration.
Well, gentlemen, yea, I walk through the valley of the shadow of death. I will fear no evil, for thou art with me. Appreciate your time today. See you soon.
Right. Thank you.